All right. With me today, it's our mortgage broker. So kind of excited. This is pretty cool to hear all the different things because he's way smarter at this stuff than we are. And so with us today is Jeff Zickefoose, the managing partner of Hamilton Realty Finance. Jeff, thank you for being here.
Appreciate you having me.
Yeah, absolutely. So let's just start off with, you went to SMU, right?
Yeah, so I grew up in Houston, came to SMU in 94, and I've been in Dallas ever since.
Okay. So are you pretty excited about the ACC move? Or
I'm very excited about the ACC move.
Are you concerned about Florida State trying to get a loan to get out of the ACC?
I'm very concerned about that. I don't know how long the ACC is going to stay the way it is now. Part of me, though, was interesting. Part of me was, I think the top-ranked non-Power 5 group gets the 12th seed in the new playoff.
Yeah.
It's like we kind of probably could have gotten that most years if we would have stayed in the American, but but I'm definitely happy to be in the ACC for sure.
Yeah, that was, when I saw them trying to get out, a lot of people had an opinion on the Florida State thing. I thought it just sucked from a standpoint of they punished a bunch of kids because their quarterback was hurt, essentially. If it was Clemson, they would have gone, and so, but, I was like, golly, I was excited. I always wanted SMU to come back to the Big 12. I was like, that just makes so much logical sense. But
I will say I'd rather be in the ACC than the Big 12.
Yeah, I
think that's more exciting.
Yeah, no, the Big 12 got really weird over the last 2 years. I'm glad we added the Pac-12 teams. There was always rumors in the past for Texas Tech to go to the Pac-12, and I was like, well, we could kind of fit in that. We're out in the desert. Everybody else is out in the desert, but we ended up just getting the desert teams to come to essentially the Big 12, which now has Cincinnati in it, which is so odd to me.
Yeah, it's good to have Houston back, though.
Yeah.
That's the one thing I'll miss. SMU and Houston always had a pretty good rivalry.
Yep.
I'll kind of miss that a little bit.
Yeah.
It's kind of cool BYU's there in Big 12. That'd be a great road trip.
Yeah.
That's what I'm excited about the ACC is I think I'm going to take one away game every year to go check out these venues. And they're great academic schools, too. So, take my kids with me, and it's like a preview for maybe a future for them.
Yeah, no, that's awesome. I had a road game picked out next year, and I got gypped on it so bad because of conference realignment. But, we played Oregon at home this year.
That's right.
It was a great game. Yep. We barely lost it.
Should have won that game.
Should have won that game. And we were supposed to go play them out in Oregon this year. And I had it all set up, man. And we were going out there, and then they had a buyout. Oregon had a buyout. And because of the realignment of conferences, and they're no longer in Oregon State's conference, they still want to play their Civil War game. And so they bought out of our contract to play in Oregon.
Do you know how much that was?
I think it was like $25,000 or something.
Oh, so it wasn't a lot. Okay.
No, it was something just ridiculous. Yeah. But anyways, so, well, let's just kind of talk about, so you go to SMU, you get a degree in finance, and,
Yeah, so I thought I was going to be a stockbroker, honestly. My whole life is what I wanted to do. And I got an internship with Smith Barney that first summer after freshman year in college. Mm-hmm. Went there, hated it. My parents actually forced me to quit after 4 weeks because I was so miserable. And then one of my mom's best friends' husband was a mortgage banker in Houston.
Okay.
Didn't know what it was, had no clue what it was. And he said, why don't you come over here and work here for the rest of the summer. Next thing you knew, I fell in love with commercial real estate finance and have been doing it basically ever since that summer.
Yeah.
When I graduated from college, I was on the lending side and worked for GE Capital for a while and Prudential, and then kind of moved to the mortgage banking side in 2013.
Explain GE Capital to me, because I haven't got into those levels of things yet in my real estate career. And when I think of GE, I think of them like as a manufacturer, but they actually have a whole capital side.
Yeah, it's crazy. I don't know if these stats are exactly right. I mean, when I was there, GE had, I think, 13 different businesses.
Yeah.
With GE Capital being one of those 13 businesses. And within GE Capital, there was 28 businesses. And ultimately, GE Capital is kind of what really hurt GE in 2009. It's really interesting. It was a very conservative company. And like everyone in 06, 07, I guess 06, 07, they started getting a little out of their comfort zone on the capital side and got a little too aggressive, and 09 came around and hurt them.
And does GE they have equity and debt platforms?
No longer. I mean, they're out of the business, but yes, then they did both debt and equity. Actually, just right around the corner. We office in the Ben Tree Towers over here.
Yeah.
2 Ben Tree Tower, where both debt and equity was there.
Yeah. Was it Greg Hamill that he worked there? Or
I don't know Greg Hamill. There was a John Hamill.
Okay.
But I don't know Greg Hamill.
There was a guy I used to call in to try to get the leasing on some of their assets. But anyway, so then you're at GE Capital for what, 6 years? And then,
that sounds right. From like 98 to 05, I think is what it was. And then left to start an office for CW Capital here in Dallas. Wasn't happy. Then went to Prudential.
Okay.
For a while.
Okay, and that was on their debt side too.
That's right. Yeah.
Was it placing debt for because they own a lot of assets?
So I was considered a generalist. So I was able to originate debt on the life company balance sheet side, as well as agency and as well as CMBS.
Okay, all right. So, and what was it? Office assets, multifamily, stuff like that mostly, or
we did a little bit of everything.
Yeah.
On the life company side, I mean CMBS, we did just about everything. The thing that I actually did a lot of on the life company side that was a little unusual was self-storage. We did a lot of self-storage portfolios, larger portfolios kind of around the country.
Yeah.
But we did a lot of industrial, a lot of grocery and retail product like that.
Gotcha. So then you kind of went to the acquisition side and you went over to Dunhill for a little while.
Yeah. So, 09, I got caught up in, 2010 got caught up in layoffs at Prudential. Dunhill was a big client of mine at Pru. Like we did a lot of loans with them on the CMBS side.
Yeah.
And they were nice enough to let me kind of hang my hat there for a little while and help them do a lot of different things. And then when the lending market came back, I went to go work for Ladder Capital, actually in this building. We office in this building that you're in on the 3rd floor, I believe. And then Randy Fleischer was always one of my best mortgage banking clients over the years as a lender. At that time, he was selling his company to JLL.
Yep.
And he'd been trying to get me to join the mortgage banking side for years. And finally, the stars aligned in 2013 and kind of started the same day he and his team did at JLL in 2013.
Okay. So what was the difference from going from like a Prudential side to a JLL capital market side? Like,
I mean, the big difference, just more entrepreneurial. I mean, you work for a company, but you're really self-employed, right?
Yeah.
I mean, that's the big difference. I think the thing that was frustrating, I mean, I would go back to the GE days too. When you work for a group like Pru or GE, it does matter what you do personally, but a lot of how you get compensated is dependent on other divisions within the company. So GE, for example, the light bulb division has a bad year. That affects your bonus, even if in real estate you have a great year, right?
Yeah.
That's the big difference from working like that back to just, being a mortgage banker. You're basically your own boss and control your own destiny, which I like and appreciate.
So y'all would work a lot with the investment sales team guys, right? If they're taking out a portfolio to kind of be there to provide debt quotes on it and stuff like that. And
we would.
And were y'all placing equity as well at the time?
We would. Yes, that's correct.
Yeah. What do you like better, debt or equity?
Debt.
Yeah,
for sure. Equities. The thing that I don't really like about equity, and I don't mind saying this because I say this to my partners and everyone, is, on a debt assignment, you hire me.
Yeah.
We negotiate a fee and we close it, and there's no argument over that fee.
Right.
The challenge with equity, in my experience, is you hire me for equity. We come up on a fee. I introduce you to an institutional equity client. They may not agree with that fee.
Yeah.
And they may try to skinny that down. And then, by the way, when it comes time for you to do the second or third deal, you're arguing over if you're getting paid anything and what that is if you are getting paid.
Yeah.
And so it's more transactional in nature versus I don't like to work that way.
Yeah.
I'm more relationship in nature.
Yeah.
And I just don't like how that tends to be.
Yeah. Yeah. No, it seems like equity would be, I don't know, there's just a lot more minutia to it, right? Like, I think when someone's going to give you equity versus debt, I think they want to get into the guts of you a lot, and so.
Well, it's a big challenge that we have. I mean, like back when we were doing more, equity in general is just harder right now.
Yeah.
I mean, a lot of people are on the sidelines, but I mean, even though I don't enjoy it, I would still do it.
Yeah.
But even when it was plentiful, I mean, that's the first conversation I'd have with someone like you, Jeremy, is like, okay, you know what you're signing up for, right? Like you're hiring me to find you an equity partner. Okay. You realize they're going to be in your business.
Yeah.
And are you comfortable with that? And I will tell you, probably a third of the time, you get a term sheet, exactly the terms that the client wants, and they start seeing the fine print and how much decision making they have with you, and they don't like that, and they end up not taking the deal. And they just go back to their old ways and just deal with their family and friends they've dealt with in the past.
Yeah.
That happens a lot.
I bet.
Yeah.
I bet. Yeah, we just executed JVAs with 2 separate groups, and it I don't know. I mean, there's a lot of nuance to it, you know, that you know, some stuff I just kind of had to agree to, and some stuff I fought, and you know, but
well, you got to be proud of that. I mean, this market right now is not easy to find that. So kudos to you that you have those 2 options. That's great.
Yeah, no, it you know, it worked out great. We got, you know, we're fixing to close our first with one group. We've closed 3 with the other group already. You know, one of them showed up at the end of the year, and it was like, hey, we got to close in 17 days, and they're going to underfinance it, but we got to close in 17 days, but we're going to get a phenomenal deal on it. And okay, great. There's the money, you know? So that helps too, right? It helps with the scalability of what we're trying to do with our platform. But I could see, you know, it's just, equity just seems like just such a, I mean, to your point, like you could get an equity guy deal all the way to the finish line, and they get a 100-page JVA, and they're like, whoa.
That happens a lot. Yes, that has happened a lot. Yes.
Because it's pretty deep. I mean, I had a lot of long weekends reading documents and understanding what I was getting into, and it's expensive. I mean, negotiating a JVA can be $40,000, $50,000. I mean, you know, so
more sometimes. Yeah.
Yeah. So, well, okay. So y'all are at JLL. You and Randy are running JLL Capital Markets. Are y'all?
Well, I wasn't running it. Tim Jordan and Randy were running it during the time I was there. And then in 2016, you know, Randy's, I guess I'll put me in that group, but like they kind of earned their freedom back with JLL. And then, you know, Randy and I left kind of together and started Hamilton. The thought was, you know, in a little bit what you were saying earlier about teaming up with some of the IS guys, in a world where a lot of people were consolidating, we felt like maybe there was a little more, there was a niche for a boutique firm.
Yeah.
The thing that we dealt with a lot at JLL that was frustrating to me as just a debt mortgage banker was there's a lot of our clients that you can appreciate, especially on the industrial side. There's a lot of clients that they're principals of industrial, but they also lease and manage third party as well, right? Well, JL does that as well.
Yeah.
And there was times where they were hiring, like if, you know, let's say your brother, Mercer Companies or whatever, right? Like JL would have hired or stole some of his employees.
Yeah.
Why would he hire me to do his debt? Like my company's still his employees. We dealt with some of that stuff.
Yeah.
There was also just a lot of always trying to cross-sell to different divisions. And, you know, we just wanted to just do what we do best, which is debt and equity.
Yeah.
You know, we also have a lot of clients too that they want to stay under the radar.
Yeah.
They don't want to be in the public eye. And if they hire a bigger firm, they feel like the whole world knows what they're doing.
Yeah.
And so they kind of like the boutique part of it where it's not the whole world knowing what they're doing.
Yeah.
So we just felt like there was a niche to go boutique when everyone else was getting bigger. And it's been, I mean, it's worked out well. I mean, we've been happy with it. And frankly, we didn't lose any clients when we left.
Yeah.
And frankly, we picked up more clients since then because of some of the stuff I just mentioned.
Yeah. No, it's I think that's probably what we like working with you guys, because you are a boutique. I don't think I'd walk into JLL Capital Markets or whoever now Newmark's Capital Markets or whatever and be like, I don't know, it just doesn't fit me in a way. And so I think that's probably our attraction of working with you. You know, Will knew Randy, I guess from some deals that y'all done with Holt Lunsford or something, or when Will was at Holt Lunsford. So that's how we got a hold of you. He was like, hey, because we've been kind of always messing with this idea. We're like, we got to have some kind of debt fund. Like we can there's an opportunity for that stuff, and we've actually started placing it. And it's like, okay, now we got to just really do a fund because this is too hard to do one by one deal. But
so did you mention? I mean, Hutton Lunsford was one of the ones that came over and started Hamilton as well with us.
Okay,
yeah. So he worked with us for a little while.
Okay,
yeah.
I think I just
he was a partner with us.
And then Holden Lunsford just went off on his own. I don't know if you saw that. They're starting a PE group for logistics operating companies.
I did not see that. No.
Yeah. So I think they own a 3PL though already. So it's probably just really growing that platform. It's probably been pretty good for them. They own all kinds of businesses.
Yeah,
so
it's a great family.
Yeah,
a great family.
Yeah, no, they've done very well. So you and Randy go start Hamilton. How many guys y'all start with in the beginning?
It was just, I guess there was 4 of us. I guess we had an analyst and then the 3 partners. So it was just 4 when we started.
Yeah.
Yeah.
How many y'all have now?
That's a good question. We're up to, I guess we have an office in Salt Lake City.
Mm-hmm.
Randy's full-time, and as you were there last week, is full-time in Tahoe, right?
Yeah.
So, and actually Nevada is a weird state that you actually have to have a license for what we do.
Yeah.
And you need a residency there to get the license.
Yeah.
So he has that license and he's there in Nevada.
Yeah.
In Tahoe. And then we have Curtis Jaggers in our office and Jason Perring in our office, and then a couple of analysts. Yeah.
That's what it's funny. Me and Randy were having brunch the other day. I was like, we'd always gone to the Hard Rock in Tahoe, and it just changed to the Golden Nugget. And I was like, so what happened with the Hard Rock? And he's like, oh yeah, we used to have a note on that thing with those guys. Yeah. So and he told me, I guess the patriarch of the family passed away or something.
Yeah.
And so. But it was just funny. He's like, oh yeah, I have a note on that. So.
Yeah, we had a mezzanine note on that.
Yeah. So, all right. Well, let's see. What are you seeing now? Trends within? I mean, do you work mainly in Texas, or do you get outside of Texas? I mean, I know your firm does, but like you specifically.
I mean, I would say most of the clients are in Texas, but I would say 50% of the assets are in Texas and 50% are outside of Texas.
Gotcha. Okay. So you're kind of going wherever the client
goes. That's right.
Gotcha. Is there different trends in different states versus Texas that you see?
When you leave, especially Dallas and Texas, you realize how spoiled we are here.
Yeah.
Like our economic drivers here are just so much better than around the country.
Yeah.
We're spoiled here in that we have phenomenal banks that are willing to do commercial real estate loans.
Yeah.
When you leave, when you get a hold of a local bank in some other state, they're just not as aggressive as they are here. And it makes it more difficult to do a bank deal when you're not dealing with a Texas-based bank.
Yeah.
It's a lot tougher.
Yeah. Now, what about Life Coast? Do they punish other markets tougher versus Texas?
I would say life companies definitely are national in scope.
Yeah.
And I wouldn't say they punish certain states or anything like that. I mean, they want to stay in the major cities around the country. They're not really, like even in Texas, I mean, they're not going to want to go to, they have an apartment deal in Tyler. They're not going to want to do that or something like that. They want to stay in the, they call them secondary markets. We call them primary markets here, right?
Yeah. Yeah.
I think Dallas hopefully is becoming a primary market in some people's eyes. It's always funny that that's secondary. It's not New York. It's not San Francisco.
Right.
It's not LA. It's not Chicago. But I'd rather be in Dallas right now than Chicago and San Francisco all day long.
Yeah.
So that's changing. But yeah, the life companies are, national in scope. And I mean, everyone loves the Sun Belt states. I mean, they just do.
Yeah. It's, you made me think of something. Did you see in San Francisco that Brookfield foreclosed on a loan they made to Veritas for $464 million for like 2,150 apartments?
Yeah. There's a lot of that's about to happen.
Well, okay. So like everybody talks about how bad office is. Like office sucks. But I feel like I hear the most loans going back in multifamily and then the most fraud of operators in multifamily.
I mean, that's interesting. I see a little bit in multifamily from the standpoint that if you did a value add bridge loan, short-term loan a couple of years ago, and you might not necessarily hit your NOI budget, and now cap rates have gapped out 150, 200 bips.
Yeah.
And you had a strike price on SOFR LIBOR that was really low, and now that's gone.
Yeah.
I think that kind of scenario is starting to pop up a little bit. But yeah, I mean, the office, I don't see a light at the end of the tunnel in the next 2 years on that stuff.
I don't see it at any time. Well, here's something I've always thought about that no one talks about in office, but like, I don't think office completely is flushed out until probably about 2030, maybe 2031. And that's because think about all the people that signed multiple floor plate 10-year leases before COVID.
Yeah, in 18, 17,
So
19, yeah.
And when they come to renew, they're probably going to renew, but they're going to give you back a bunch of floor plates. And, if they have 5, they're going to keep 1, 1.5, maybe 2, and give you 3 back. And you're not backfilling that stuff.
That's fair. I mean, I would say my office clients who have leasing arms would say that there's momentum out there for office leasing for space that's like 10,000 square feet and lower, some of the smaller users. But those big blocks, there's just not a lot of tenants looking for that stuff right now.
Well, so my thought on the big blocks is big blocks are occupied by very mature companies who are now having to deal with employee retention. And so they're going to these hybrid work schedules. So they're going to scale back their footprint because of this hybrid and hotellings type stuff. And then to your point, 10,000 under, I think there's going to be velocity because those are growing companies. And so they're going to grow. And we're already kind of maxed out in this space, right?
Yeah.
We'll we're stuck here for a couple more years, but we'll definitely probably go to a larger footprint. So, but that was kind of my, I used to represent Children's Medical Center on their industrial stuff. And that's what, I was like, how many floors do you have at Trinity Towers? They had like 7. And he's like, man, they don't cut that, at some point. So I was just like, man, that's just one user.
Well, think about that. I mean, that's in Dallas too, right? I mean, and we're better than most cities.
Yeah.
So you can imagine, what's happening like in New York and places like that.
Yeah.
Someone brought up a good point recently too. It's like the tax bases and the tax dollars that aren't going to be paid to the local authorities is going to start affecting services, I would think, at some point, right?
Yeah. Yeah.
Fire department, police department.
Yeah. That's what I mean. And we don't, like New York, I mean, they got a lot of vacancy, That's going to be, and most of them you can't convert to residential. It's just.
They're trying, I mean, they are some. I mean,
yeah.
I will say when I was at Prudential, we did a conversion of an office tower to multifamily downtown here in Dallas.
Yeah.
And it didn't work out so well because ceiling heights.
Yeah. Because once you open and expose that ceiling, then you got to put the plumbing in through it for each one.
And it just they were low ceiling heights compared to something that's new.
Yeah.
Right.
Yeah.
And that didn't go over very well with renters.
Man.
And that's the problem with a lot of the office is just especially the older stuff that's struggling.
Yeah. Yeah. The stuff that needs to be converted can't be converted.
Right.
It's golly, I couldn't imagine going through a project like that. Like, how long did that take? How long did it take the sponsor to do it?
Was 07. I don't know, 06. I don't even remember. I don't remember.
I mean, getting a make-ready done on a Class B industrial building takes 30 days right now. I can't imagine doing something like that. It's an interesting stat, though, that I'd like to give our contractors is the Empire State Building was built in 13 months. What's your excuse? And they're like, is that true? I'm like, yeah, it's true. They built it in 13 months. I guess there wasn't as much labor shortage there as there was today. But what are you seeing in multi right now? Because y'all do a lot of multi. Are you seeing?
We probably do more construction multifamily than we do perm multifamily, just because we don't have agency.
Yeah.
We don't have our DUS license or Freddie Mac license. But I mean, the construction stuff, we're still getting deals done, albeit at lower leverage than we were before.
Yeah.
There's a real, just in general, it somewhat ties to multifamily, but in general, like there really is a big bifurcation on loan size. So, $20 million and under,
Mm-hmm.
if you have that size of loan, it's still readily available to get debt. There's still a lot of the smaller regional banks around here that are active.
Yeah.
You start getting into some of that larger scale stuff, over $30 million, and multifamily construction falls in that. It's a lot harder to find that loan.
Yeah.
And it's just a handful of people that can write that check and do that. So they have the ability to delever from what they were doing in the past and get recourse. And, it's definitely harder to find that out there.
So a lot of banks now too are pushing deposits. They're like, oh, well, we'll do your loan, but you need to move all your deposits. My argument to that is with these banks is like, do you understand the undertaking that it is for me to move my accounts? And so this happened to me. We were doing a deal with a bank. I think this was in 21. We closed 2 deals with them on the same day, on a Friday. And they were, throughout the whole thing, they were pushing hard for my operating accounts. I was like, you'll get the operating accounts for the properties,
right.
but you're not getting Matador's operating accounts. And I told them, I said, look, I go, you can cut me a $50,000 check. That's probably what it will take for me to move it. And they're like, what are you talking about? I go, because it's going to take me and my employees a full quarter to go through the butt whipping that you're fixing to lay upon me. and you know what happened? We closed that Friday. That Monday, I called them with another deal. They go, we're out of commercial lending. I was like, wait a second. You wanted me to move my deposits to your bank and you can no longer even service me. So now when a bank says that to me, I go, sure, you just got to guarantee that you'll be loaning on commercial real estate. And they're like, well, we can't do that. I go, well, then what's the benefit of me coming over there? I mean, you don't even know if you can provide me service.
Right.
So they don't, they give me.
I mean, it's definitely a topic of conversation a lot.
Yeah.
We're still able to find some banks that don't require that.
Yeah.
They always want to have the conversation, but post-closing, can we talk about it? Right.
Yeah.
Love that. I think what's funny is, some banks are like, I want 25% of the loan amount in deposits to do a loan.
Yeah.
And historically, there's always that rule of thumb that, the guarantor needs to be net worth 100% of the loan amount and 10% of the loan amount in liquidity.
Yeah.
I'm like, a lot of my clients aren't even 25% liquid loan amount. Even if they wanted to give you all their deposits, there's not enough to satisfy that.
They're real estate guys.
I think that is always funny when I hear that comment from some bankers, which they say back to me, well, it may not be a client we really want to bank anyways. I'm like, that's fine, but you're missing out on a lot of good deals out there.
I mean, these are real estate operators. Like that's what I always, the real estate operators are always broke. Like you're always you're cycling money constantly,
It's true. I mean, over the years, I've seen a lot of, as you imagine, being on the lending side too. I've seen a lot of balance sheets that are 100 million net worth guys with 800,000 liquid.
Right.
I mean, it happens. I think the other thing too that helped the deposit conversation a little bit back last spring is when the 2 banks failed.
Yeah,
especially around here, we have a lot of smaller banks, somewhat new, not really household names. Like, I want deposits. And then after that, it was like, okay, like I will help you convince Jeremy to give you some deposits, but not more than $250,000.
Yeah.
I mean, why would you do that?
Yeah.
Like someone they don't really know, they've done one deal with. Like, I mean, you have to be careful. And that, when I said that to some bankers, they're like, I get that. Like, I understand that.
Yeah.
Well, what can you do? I mean, I'll take 250. Okay. Like, they come off $1 million really quickly. Okay. I'll take 250.
Yeah.
So keep that in mind. You can always use that argument with some bankers, especially if it's not a household name.
Yeah.
So,
I thought it was interesting though. We were working on a deal this year and we got a term sheet from a very large bank, and they gave us a term sheet. Our equity partner, we kind of went back and negotiated that because our equity partner had some pretty large deposits there. And they came down.
I remember the deal.
Yeah.
Yes, I remember
they came
that.
down.
Yep.
And then they just called one day and said, hey, we're out.
Yes.
Like, we're done.
I know.
And it was so funny. This bank literally had a luncheon 30 days prior Texas is strong. We're open for business. Just whoop.
Yep.
We did get a deal done with those guys, though.
That's right,
and they've been great to work with. So that's been good.
They are,
but and I'm sure we'll do more loans with them in the future here. So whenever they get back online, but it was just so funny that
and that bank is always one of the better interest rate banks too.
Yeah,
like when they're in. And they love industrial too. And so they can be pretty aggressive on industrial.
Are you seeing anybody bank office right now?
I will tell you, I haven't asked the question.
Yeah. Do you just not take the assignment?
Well, there just isn't any assignments to take.
Yeah.
I mean, all you're doing with the existing, like we had a loan that matured. It was a debt fund deal that matured and it's performing last year, and we just negotiated a 2-year extension. I mean, that's what you're doing is you're just trying to extend what you have.
Yeah.
That's part of what we've seen. I mean, last year was for sure slow for our business.
Yeah.
Mainly because everyone knows there's not a lot of acquisitions happening last year. Okay. Yeah. But what people forget is I have clients that have executed their business plan and they're usually ready to go to perm financing.
Yeah.
But they may be in a 5-year fixed rate, 3.5% rate with the bank.
Right.
I mean, I tell my client, just stick with it. Like, hey, don't pay that off. Like, it doesn't help me out to say that, but like, you should just stick with it. What we've done in some cases is we just added a B note at today's rate.
Yeah.
To get, if they need a little more dollars and need to get some cash to their clients, just add a B note to the existing A note.
Yeah.
And then blend it, it's still a pretty good rate. That's kind of what we've done more of. We did that more last year than just paying off the bank and doing a perm loan.
No, it's it was slow. It was pretty slow for us last year too. I mean, the year before we bought $56 million. Last year we only bought 29. And then out of that 29, I think we did loans on 1, 2, 3. I think about 50% of them were owner financed.
Yeah. And
there was a point in December where we were in title on 6 buildings and only one had financing on it. We just started asking the question.
Yeah.
We made a nice little marketing piece to go with our LOIs. It's like, hey, consider owner financing this to us. You make this much on your money. We're usually buying from older one-off sellers. They're kind of like, well, that's something to do with the money, So that's where I would say, figured out a bunch of deals that we could make last year. So, but it seems like it will loosen up this year. And, a lot of people keep asking, hey, well, we're going to wait till the bottom. I kind of feel like we've bottomed on pricing. Everybody's like, oh, well, the prices are going to come down more and I'm speaking specifically in industrial, but like, I feel like we've kind of come down to that. If it was just say $150 a foot for a building in Brook Hollow, it's now $125, but it's going to be holding right there.
I tend to be looking at the correlation with interest rates, and interest rates are lower than they were, right? So I agree with that.
Yeah. So the 5 and 10 years kind of been fluctuating the past couple of weeks.
Yeah, I will say, like I said this morning to someone, 8 weeks ago when the Fed came out and mentioned maybe 3 cuts this calendar year, December was positive. I wouldn't say there was a lot of activity happening.
Yeah.
There was I had a lot more calls from clients that kind of been on the sidelines saying, okay, I have a loan maturing in May, June of this year. Maybe we should take it out.
Yeah.
I'm feeling better about things. But treasuries pop back out. I've been so busy. I haven't seen what happened today.
Yeah.
But they're back out 25 bips in the last 5 days.
Yeah.
And all of a sudden, I feel like all that optimism maybe in the last week has gone away a little bit.
So what is driving that? Like, what pushes that factor back and
It's
forth?
inflation. I mean, recently it's the inflation, right?
Yeah,
like
right.
It's the inflation's not coming in as much as they thought. And then what's going on in Yemen and the Houthis and them with going, pirating the ships, if you will, and rerouting the ships that's only going to make inflation worse, right?
Yeah.
So there's a little bit of that is why that's happening. That being said, on a positive note, I would say that the CMBS world, there was a couple deals that went to securitization last week, and the bond buyers loved the paper, and spreads have ripped in 30, 35 bips
Yeah.
in the last 5 days. So, I mean, I've got actually on your deal that we're in the market right now.
Yeah.
You know, we're asking for a 65% leverage. 5-year. I got a 5-year IO quote at 250 over the 5-year treasury today on a 5-year CMBS deal.
Yeah.
That was high threes a month ago, that spread.
Yeah.
That's how much the 5 years come in.
Well, that's good. I mean, if spreads are coming down, then...
I mean, usually, and when you go back, I'm just thinking back to, starting in 98, typically when indexes go up, spreads come in.
Okay.
That's what was really unusual about last year, was that wasn't really the case. And what I just said would happen in the CMBS market is kind of the first time we've seen that in a while, which takes it back to the historical norm.
Yeah.
But yeah, I mean, indexes have gone out the last week, but spreads have come in from a CMBS perspective. I'm not saying that for life companies or banks or anything like that, but so that's good.
So do you think last year when spreads were going up and then, when indexes were going up and then spreads were going up with it, was it just fear?
That's what happens, right?
Right. Yeah. So then that tells you that there's, people that are starting to have more confidence in the market than if they're bringing their spreads in.
I think so. I think so.
So that kind of gets me just outlook for 24, sounds like it's going to get back on track.
It really just comes down to the Fed. And if we have 3 cuts or if we have any cuts, if we have no cuts, I don't know what it's going to be like.
Well, I think there's going to be cuts because Trump is the most likely presidential candidate and they're going to do everything they can to make prop Biden up some more. So.
Yeah, I mean, historically in our world, though, like election years, there's really not a lot of movement up or down. I mean, it's just kind of stable.
Yeah.
Normally, you like that, and where we are now, you kind of don't want stable. You kind of want it to come in a little bit. I hope that happens this year.
Yeah.
It just really depends on inflation numbers. It just really does, and the Fed's next announcement, and what they're saying and talking about.
Well. Okay, so one question I always like to ask, what are some resources that you like to look at on a regular basis for your world to just kind of stay in tune with everything? And
I mean, so the guy I follow the most is JP Conklin at Pensford Financial.
Yeah,
if you're not on his mail list, you should look it up, go to his website. He sends an email out every Monday morning, which is kind of an update of what happened in the past, what he thinks, like the past week, what he thinks going to happen. He's also we started this conversation with football.
Yeah.
He's a big football fan. So he has a lot of analogies to football and a lot of stories to football.
Yeah.
Unfortunately, he's an Eagles fan. He's a big North Carolina fan, though. Yeah. He lives in Charlotte. But he's definitely my go-to when I'm just kind of looking at predictions and interest rates and what the Fed's saying. He's got a pretty good pulse on what's happening.
Okay. So mark that. Yes. Go check that out.
That's right.
So what about any books you like on commercial real estate or just any books in general?
Well, not. I don't know if I've ever read a commercial real estate book that's good. I really like nonfiction. So Ben Mesrich is one of my favorite authors. All like the Accidental Billionaire. I'm blank on the guy's name. The guy that wrote Silk Road, that author is, it's not Ben Mesrich. It's, I'm blank on his name, but I like a lot of the nonfiction stuff that's written out there. Although I will say I have not, I've probably started 2 books in the last 12 months and haven't finished them. I haven't found a good nonfiction in the last 12 months. So if you have a recommendation, let me know.
Well, I just bought one and it's written by Henry Cisneros. I remember Henry. Yeah. And because we've kind of made the commitment to go down into Houston this year and buy buildings. So we're now more Texas Triangle focused. Okay. And he wrote a book called The Texas Triangle. And so I bought a big hardcover. Okay. So I'm going to set it in here, and I just bought it on Kindle too, but I just started reading it.
So what's it about?
It's just about the economics of the Texas Triangle and how powerful it is. And just talks about the GDP of it compared to countries, and just, I'm only about 2 chapters into it, but it's, I was like, well, everything I kind of do works in this area. The land development deals we do down in Temple, that's all, down there in this, and we're adding Houston, and it's like, well, I just want to learn everything I can about it. So just kind of interesting. I kind of like nonfiction stuff too. And then a lot of it ends up being like Texas history type stuff. And so, but I like a lot of biographies about cool people too. So
I'll be curious if he gets into the light rail, like if he gets into that book, if it's, or the, I'm not the light rail, but like the speed trains between the triangle, if that ever happens.
Yeah. I just think about how long would it take? How long would it take to get easements all the way down? People, I mean, you're dealing with some people. I mean, I'm doing this land deal right now in Temple, and I got 9 owners on one piece of property and 4 on another, and it's like you're going to run into that just constantly.
Yes.
Well, brother said no. He said he wants more money, and so. But all right. Well, let's wrap this up. Any other thoughts, opinions, hot sports opinions? What are the Ponies going to do next year? Had a good season. Kind of blew it in the bowl game, though.
Yeah, I mean, I could tell a story, but I can't tell a story on this public thing. But I think there were certain situations that happened is why. But yeah, no, I'm excited for next year. Who knows what we expect next year? I mean, we have a lot of transfer portal guys on the line, both offensive and defensive line. So we're beefing up for that.
Yeah.
I'm a little bit worried about in the wide receiber room on what that's going to look like. But I mean, we'll be competitive. We'll be competitive. I mean, to me, I mean, hope SMU fans out there don't get upset with this, but I mean, if we're bowl eligible, I'll be happy because we have a hard non-conference. We play BYU. We play BYU. BYU I think comes to Dallas.
Okay.
We have TCU, BYU, and then we had someone that just Vanderbilt. Just, I think they bailed on us, kind of like what Oregon did.
Yeah.
So I think we're looking for a replacement for that one.
Yeah.
But yeah, we have Florida State coming to Dallas next year.
Oh, that's cool.
That'll be fun.
Yeah.
Hopefully they stay in the conference a little bit longer.
They're getting rid of the Hilltop, though.
I know. My kids are disappointed. Yeah. They didn't go to a game last year because the Hilltop's not there.
Yeah, it's all.
They like to go and just run around with their friends.
Yeah.
That's
Well, it's kind of like an adopted team for me since my nephew's in school there. So I track them and whatnot. So, but, well, all right. Well, anybody listening, if you need a mortgage banker, this guy, he's kind of the ninja at it. He knows what he's doing. Reach out to him. We'll have his contact in the show notes. But thanks again, Jeff. Thanks for being on.
Thanks for having me.
We'll do this again.
Yeah, appreciate it.
All right.
Anytime.
Thanks.